So we're going to spend some time and talk about a little bit of the differences between IRAs and Roth IRAs, but more importantly, a strategy that we've been utilizing for the last several years, which is known as the Backdoor Roth IRA. And then recently, some developments with inside 401k plans have created what's now being commonly known as a mega backdoor Roth 401k. Just in general, we believe Roth IRAs are probably the most underutilized investment vehicle for retirement planning. Real quick, Shane, why do we love Roth IRAs?
That would be tax-free growth, Rory.
Exactly.
There's nothing better, in our opinion, than tax-free growth for our clients.
Yep. We think that Roth IRAs really can be a game changer if they're utilized correctly. Many reasons why they might be underutilized is just a lack of education, a lack of knowledge, and a lack of planning. So that's something that we hope to solve here today. A recent Forbes article actually mentioned that only 1/10 of the funds that are invested in retirement accounts are in Roth or Roth IRAs. So that means 90% of the retirement assets are traditional or rollover IRAs, which we know come with taxes for every single withdrawal and distribution. Big difference between the IRA and the Roth IRA is if managed properly and handled correctly, Roth IRAs are not taxable, even the growth for future distributions. So we think it's vital to be aware of Roth IRAs and take every advantage of any opportunity you have to transition assets into Roth. So the backdoor Roth is a phenomenal strategy that we're going to go through today. So we're going to kick this off by starting with the backdoor Roth IRA. How to do it? So it's not overly complicated. What you need is to have an IRA account open or set up a traditional IRA and fund that with post-tax dollars, meaning money from a savings account or a checking account. You're not able to fund the Roth IRA with stock or securities from a contribution standpoint. So you're going to fund this in terms of using assets and cash, move money into an IRA, but make sure you're not coding this as a deductible contribution. You want this to be a non-deductible, meaning a post-tax, after-tax dollars transitioning into an IRA. That's a temporary spot. That's kind of a pit stop. And then step number 2, that's all it is 2 steps. Fund an IRA with post-tax dollars, step 1. Step 2, convert those dollars to a Roth IRA and then receive the benefits of that Roth IRA in future tax-free growth. So not overly complicated, but who is this relevant for? Who can do this? This is really for high income earners. So these are individuals that generate a substantial income and they are already phased out of making Roth IRA contributions. Shane's going to talk through some of those contributions on a later slide, but this is for individuals that can't make a direct Roth IRA contribution because they make too much money. Their income's too high, so they're prevented from making a Roth IRA contribution. They're going to go through the back door, and that's who can utilize this strategy. Now, you do want to be a little bit careful. If you have an IRA presently with pre-tax dollars, meaning likely those are funds from a 401k plan, an old 401k plan, or maybe previously you actually made deductible IRA contributions. Do want to be careful of converting any of those dollars to Roth because that will likely be a taxable event. This can be a little bit confusing, so we're going to go through an example of that and kind of talk through how you want to be aware if you happen to have IRAs. That may not be a viable strategy. You might want to back off and not do a backdoor Roth if you have an existing IRA account with substantial pre-tax assets. But in short, it's not an overly complicated strategy, but something that we rarely see done and we very much advocate for. So as we move through here, Shane, let's just back up a bit and let's talk through last year and this year contribution limits and also what are these phase out ranges that individuals need to be aware of when they're making IRA, especially Roth IRA contributions, and whether or not they're eligible to do so.
Yep, and that's a great introduction, Rory. And yeah, I think you hit it on the head here. Kind of just starting with the basics, right? When it comes to IRA contributions in general, right? You can see on the top here, as Rory just alluded to, these are the same contribution limits from last year to this year. So there's been no changes. You can see the contribution limit for anybody under 50, right, is going to be the $6,000. No change for that. And that goes for whether or not this is a deductible traditional IRA contribution, a non-deductible traditional IRA, or a Roth IRA. All of them are going to have the same contribution limits. You can see once you hit the year in which you're going to hit 50 years old, you can also do a $1,000 catch up. So now that becomes $7,000 for any individuals in the year they're going to hit 50 or above. Okay, I'm kind of going to skip down to the bottom here just for the purposes of this presentation, just to talk about what Rory just discussed, which is the phase out limits for the Roth. So you'll see here, one of the most important things that I like to have clients concentrate on is that the Roth IRA phase out limits are based on modified adjusted gross income. So not just simply your adjusted gross income. So just from a high level perspective, what is modified adjusted gross income? Again, this is something that you can always go back to your accountants with, or obviously talk with Rory and I with towards the end of the year if you're unsure of where you are. But the term MAGI refers to an individual's adjusted gross income after taking into account certain allowable deductions and tax penalties. Okay, it's an important number to understand since it can help you reduce, right, your taxable income. And one of the number one things that's going to help reduce that, right, is your retirement account contributions, right? So for anybody on this call or anybody who's doing this, right, that has substantial 401k contributions, right, whether they're maxing out or getting close to it, right, that's going to help reduce that number for you. Okay. Also factors in eligibility for benefits like student loan interest deduction and the child tax credit, and then establishes eligibility for income-based Medicaid coverage or health insurance subsidies. So again, there's a number of things that go into it in terms of where you're going to fall when it comes to your MAGI, right? But just remember for the most part, right, that it's going to be based off of MAGI rather than AGI. So you can see here, right, the most important thing is that both of these numbers have been adjusted upward from 2021 to 2022. So you can see for individuals starting on the bottom here, in that phase out range was about 125 to 140,000. You can see they've increased that by about $4,000 on each side, right? So now it goes from 129 to 144, right? And for individuals filing jointly, right, it went from 198 to 208 up to about $6,000 on each side to about 204,000 to 214,000. Again, those are phase out ranges. So sometimes we've had individuals who fall in the middle of that, right? If you are truly unsure whether or not you're going to be, just under that, above it, or maybe somewhere in the middle, right? Rory and I always encourage clients, let's revisit this come, beginning of say 2023, when you're going to be filing your taxes, right? As long as you have not filed your taxes, you will be able to do a contribution for 2022, depending upon where your MAGI came in. So it's always good, I think, to reconnect right before you officially, click the submit button on TurboTax or with your current accountant. I think it's always good to kind of see where that number came in, see if there's an opportunity for you guys, to do that contribution for the year. So Rory, why don't you talk to us a little bit about, the difference between the IRA and the Roth and why, we really think it makes, so much sense, especially going forward and growth wise in the future.
Yeah, absolutely. And those are good points there, something to consider, that if you're under those phase out ranges, make that Roth IRA contribution. There's no other step needed. However, if you're going to be above and you're a high income earner and you're phased out from making the Roth contribution, then this is a perfect strategy for you, right? Utilize the back door, make the IRA contribution, wait, and then make that conversion to Roth, reap the benefits of the Roth. Why do we like Roth IRA so much? Well, as Jane mentioned, it's tax-free growth, so long as you're doing it correctly when you're holding. The requirements are 5 years since the establishment of the Roth IRA and waiting until 59 and a half for those withdrawals. You meet those requirements, and even the growth is going to be taxable, opposed to a traditional IRA or a rollover IRA, which is funded with pre-tax dollars. That's beneficial in the year that you make the contribution because it's going to lower your income. However, that contribution plus all future growth is going to be fully taxable as income in the year that you take the distribution. The big difference between the two. pre-tax and then fully taxable versus I'll pay the taxes this 1 year and 1 year only, and then benefit from completely tax-free growth, even on the assets that I contributed and the growth associated with those. So tax-free growth is the number one. Number two, taxes are likely to increase. Many economists believe that due to our current national debt and government spending, this is going to lead to some higher taxes in the future. In fact, we do know that in 2026, the income rates in every single bracket are sunsetting and set to increase for maybe 2 to 3% per income bracket level. To the 22% tax bracket to transition to the 25% tax bracket. Again, we don't know, but as of right now, that's the course that we're on. So with taxes increasing, if you believe taxes might increase or your income might increase in the future, then the Roth IRA is an instrumental piece of a retirement vehicle, as you won't pay taxes in those distributions. Number three, there's no minimum distributions. So you're not forced to take withdrawals from Roth IRAs, unlike a traditional or a rollover IRA, in which case a forced minimum distribution requires a forced taxable event. This can help investors in retirement. If you're in retirement, currently utilizing a withdrawal strategy, when you incorporate the Roth IRA for distributions, that does not increase your taxable income base. So that can be very, very helpful for many years past the initial contribution, is keeping taxes lower in retirement. Every dollar that comes out of an IRA is taxed as income and could push investors into higher tax brackets. We're seeing this all the time with clients that are over 72, forced to take minimum distributions that they frankly don't need. That's pushing them into higher brackets, creating more taxes. And then lastly, which is kind of uncommonly discussed and planned for, is there's now an inheritance benefit to Roth IRAs due to the Secure Act of 2019. So 2019 Secure Act changed dramatically how the inheritance of retirement assets it takes place. So now there's a 10-year payout for any non-spouse beneficiaries. That means that the individual who inherits, like a child, has 10 years to fully liquidate that inherited IRA, or traditional IRA or rollover, and all of that will be taxable distributions and taxable to that child. However, if the child inherits a Roth IRA, or again, a non-spouse beneficiary inherits a Roth IRA, they still have that same 10-year requirement, but all of their distributions are tax-free. So if you think about it, you actually can get an additional 10 years of tax-free growth past your lifetime. Very, very advantageous. So as we move along, we did mention be careful of creating a taxable event if you already have an IRA that is holding pre-tax assets. So in this example, individual has a $44,000 IRA. Let's just say that that's a rollover from an old job, an old 401k. If you then make a $6,000 post-tax or non-deductible IRA contribution, you now have a $50,000 IRA. Many investors, unfortunately, think that they can just cherry pick and move that $6,000 contribution into a Roth, thus creating the backdoor Roth IRA. That's not the case. So the IRS is going to tax retirement accounts on a pro rata basis of pre-tax assets relative to post-tax assets. So that means that any distribution from this IRA is going to be 88% taxable, whether it's $6,000 or the entire $50,000 gets converted to Roth. 88% of it is going to be taxable because that is the pre-tax portion of the account. So something to be aware of. We also share the analogy with clients. If you don't have any IRAs, we set up an IRA for you, make that $6,000 contribution. Let's say we wait a month, or you wait a month rather. It generates $5 worth of interest. It sits in a money market. It earns $5 of interest. Now we convert the $6,005 into a Roth IRA. That $5 of growth will be taxed as income in that current calendar year. So that kind of helps tie it together. Hopefully that's a better example for you. In terms of when do you convert, that's up to you. We typically tell clients you want to pick the brain of your CPA or an accountant and get their gauge on when they might advise you make the conversion. Typically, most clients, and what we would advocate for, is sooner rather than later. right? Transitioning funds into a Roth so that you benefit from tax-free growth is something that we think you want to take advantage of on a sooner basis. In addition to that, if the assets grow in the IRA post-contribution, just in that example that we mentioned, any growth is going to be taxable as income. Shane, let's go through this, which is some of the math behind why. Why is the Roth IRA valuable? Why are backdoor Roths or Roth contributions valuable? The key is going to be time, as you can see here, but walk us through this very simple calculation.
Yeah, so it's a great segue, Rory, because again, this is one of my favorite slides, and I think it's one that you and I would both say we often probably go through a lot of times when it talks about, talking about clients' kids, right? Or, whether or not they're doing Roth contributions for clients' children's. And I would say, one of the biggest things that we do and we encourage, right, is for, say, a client's children that has an old 401k, right, that they've rolled into an IRA for, say, maybe $10,000. One of the things that you can do, right, is you can realize you can convert that $10,000 in IRA into a Roth IRA, right? You're going to realize that as income. Hopefully it keeps them underneath a certain income bracket. But let's just say they're single and making $80,000, right? This now allows them to start that, that backdoor Roth contribution. Or simply if we say, okay, somebody, right out of school making making $50,000, right? They start doing Roth contributions just based off of the income limits and then slowly rotate over to the backdoor Roth, right? And I think what we're trying to allude to here is really very simply, right? Starting with that base amount of $6,000, right? You're doing it at the end of every period, right? So the end of every calendar year for 25 years. And we're assuming a 9% interest rate or a 9% compound rate on your growth, right? Again, the $6,000 is per period. 9%, again, stocks historically return about 8%, right? Over the last 25 years, they've done even better than that. So again, this is just an example that we utilize, right? But essentially look at the value that you can create inside of a Roth IRA by simply doing $6,000 a year for 25 years. You can see the basis, right? The total amount of deposits, right, that you put in over the course of that 25 years was $150,000. However, your future value, right, by doing this is now $560,000, which means that you've created $403,000, $404,000 in tax-free wealth, tax-free growth. And this is just for one individual, right? You could have, an individual and a spouse doing this for 25 years, right? Then all of a sudden, right, you're talking about, $1.12 million and $800,000 in growth. To take that even a step further, right? We might not be touching this for 25 years, right? So when you're 50 years old, you may not be touching this until, you're 60 or even 70, right? Which means that now you have $560,000, right, at 50 years old, right, or 55 years old, right? That is also going to continue to grow tax-free forever, right? If you can get a 7% rate of return over 10 years, that money doubles, right? So just using this example, right, we go from $560,000, even by shutting it off after 25 years, we go from $560,000 to 1.12, right, to 1.68, right? 2.68, right? So you can see how the compound effect just goes and continues to grow, not to mention, right, all of that money, as Rory noted to, right, as long as this is open for 5 years, and obviously in this example it would be, all of that money, that growth is all going to be tax-free. So this is just a very simple calculation that Rory and I found, and we love to just flash on the screen to show, like, hey, it might not seem like a lot of money, but when you do it for a long period of time, right, it really, really is going to add significantly to wealth, but more importantly, tax-free wealth.
Yeah, I mean, it can almost get away from you in terms of looking at these numbers and you're scratching your head. But that's what blows us away, right? Why is this being underutilized? Why are individuals not setting themselves up? Obviously this is habit-based. If you can stick to the habit of either making the Roth contribution, if you're under the phase out, or if your income increases and now you're phased out from making the Roth contribution, utilize the back door, create consistency, and do this for 25 years. You can see these numbers really grow exponentially. And we're using a 9% rate of return here. This is an individual that is coming out of college, they should be aggressive. And, you would hope to achieve double-digit returns if you're going to be mostly invested, in stocks for the long term. So we're using a 9% rate of return, but you can use a 7% rate of return. It's a simple financial calculation. Google financial calculator on the internet and plug and plug. It's great to do individually, great to utilize with children or friends or colleagues to kind of demonstrate that, yeah, you do this 1 or 2 years, there's an impact, right? It's beneficial. But if you can do this for multiple years on a consistent basis, I mean, this is wild. $400,000 of tax-free growth generated. If this was done with pre-tax contributions, that growth would all be taxable in the year that you take the distributions out. So it's vastly different than your traditional IRA or 401k. So that's kind of the why. Hopefully that resonates. Hopefully that opens some eyes and maybe gets individuals a little bit more active with making Roth contributions if you can, or helping loved ones make Roth IRA contributions. Or if you're phased out and you're a high income earner, you want to stock some additional money away and you don't want to pay taxes, take a look at this and we can work with you to execute it. So we're going to round out the call on the mega backdoor Roth 401k. This is a strategy that isn't as wildly available because there's a couple of requirements here. So how do you do the backdoor Roth? Well, there's a couple of things that's needed. You need you need to be an active participant of a 401k plans that allows after-tax contributions, number one. Number two, that 401k plan has to allow in-service distributions, movement of money from after-tax into the Roth portion of the 401k, or out of the after-tax portion into a Roth IRA. And you need the cash flow. You need the ability to save at a pretty decent clip. So cash flow and an ability to maybe increase your savings into the 401k beyond the maximum requirement or the maximum 401k contribution, which this year, if you're under 50, is $20,500. So the ability to overfund your 401k is that last requirement for who can take advantage, who should take advantage of the mega backdoor Roth 401k. Briefly, we had it here. What is it? Well, it's a tax shelter strategy that's available to employees, and they are allowed to make substantial, keyword, after-tax contributions in addition to the pre-tax deferrals. So theoretically, you're getting the best of both worlds. If you make that $20,500 max contribution in the 401k pre-tax, you're lowering your income by $20,000. And then if you have the ability to fund even more on top of that, you can make after-tax contributions that will route to a Roth IRA for future tax-free growth. If you really want to supercharge Roth, you can do $20,500 directly to the Roth portion of the 401k, plus make after-tax contributions and get that converted over into the Roth IRA and Roth 401k. Huge opportunity. So as we go through here, Shane, just maybe take us through this. This is an example. What we're using is an employee under age 50, $150,000 salary. So they're working at a large corporation, and what they're doing is getting a company match equivalent to $9,000. Maybe just take us through what these numbers and what the potential is for the mega backdoor Roth 401k, and then touch on a little bit of your work with many of our clients in the companies and actually the logistics behind that, if you will.
Yeah. Yeah, it's a great point, Rory. And we, again, this is an example just showing for, an individual under the age of 50, right? Where the max contribution that you could put into a 401k from a pre-tax limit, or for, if your company offers a Roth 401k, the limit is still the same, right? You could put every dollar into a Roth 401k if you wanted to, but this is for an individual doing pre-tax contributions, right? So under 50 years old, that max contribution is going to be $20,500. If you're over 50 for this year, that max is going to be $27,000, right? But like I said, for the purposes of this slide, we'll just use the $20,500. I think the biggest place where individuals get confused about this mega backdoor Roth is that the employer contribution counts towards them. It does not, right? So the employer contribution, right, will add on to your federal income limit, right? But you still have $31,500, right, that you can put into the 401k. That would all be in after tax, Okay. So there is, if you're a great saver, as Rory alluded to, right, pretty much depending on your company match, right, that you're getting, right, there's pretty much a lot of times, anywhere from $25 to $35,000 extra that you can be putting money into the 401k, right? Many of the companies that offer this, I'm sure individuals and employees are on the call, right? You think about, Amazon, Verizon, Merck, right? Pfizer, some of the bigger Fortune 500 companies. And what happens typically, right? And I think one of the biggest involvements we've seen in the 401k industry, but I'll go back and say the same thing. I think a lot of our clients will remember that at the end of the year, right, because all of their money was going in after tax and not actually into a Roth 401k, our strategy would be to roll that money out of the 401k into a Roth IRA. And that way, the money in the Roth IRA would continue to grow tax-free forever, right? Rather than, I would say arguably 5 years ago, that money would stay commingled with the pre-tax dollars and would not be growing tax-free, right? So our goal, and as Rory talked about in the last slide, you have to be able to have that in-service contribution, but our goal is really to get that money, right, into the Roth IRA or Roth 401k. As I mentioned, one of the biggest involvements that we've seen kind of in the industry is now, right, many major companies are allowing you to automatically convert those after-tax contributions into the Roth 401k, right? Typically, I've done these with clients before. Most of the time, it's daily. If not, it's weekly, right? But the best part about that is that we no longer have to go in and take that extra step to roll the money from your 401k into, say, the Roth IRA that we're managing here at Ausperity / Fidelity. So again, being able to,
and just to jump in, they're helping. It's evolving from a manual process that the actual employee has to take advantage of and execute to now being automated, which we think is fantastic. And as Shane pointed out, a huge involvement in the companies making this strategy more accessible and available, because there's a lot more moving parts to the mega backdoor Roth 401k than there is just doing a backdoor Roth IRA. And one of the things that we always share is this is something where you're going to want to review the summary plan description associated with your 401k. You likely want to have a conversation with a tax professional and your CPA. And you also want to do a discussion with one of the 401k representatives. Because we have seen some taxable events occur with it being executed incorrectly. And that's kind of an unpleasant surprise. It's a big tax bill because I should mention, maybe there was after-tax dollars there from years ago, and you just flipped it into the Roth 401k. Well, the growth of that money was converted in taxable. So this is something that has got a lot more moving parts. But if we showed you a slide previously with $6,000 over 25 years and the growth there, imagine this 30,000 if that's done for the same 25 years, or maybe if it's even done for 10 years. Again, it's plug and play. Pull out the calculator and take a look at it. We've done financial plans for clients, and if it can be done and the client can save that much money, this is shaving years off their potential need to work. This is a retire at 55 instead of retire at 59 or 60 type of opportunity. So strong that you got to be aware of your cash flow, right? You're going to put a lot more money into the 401k. Your take-home pay is going to be less. So you want to be aware that you can manage that from a cash flow perspective. But if you're already saving money in a non-retirement account or an investment account, then you got the ability to do so. Maybe you're going to save less money into a brokerage account and direct those funds to be overfunded into the 401. But the biggest thing is your company allow it? And there's means testing that has to be met. So this is not every company or corporation. Shane rattled off a number of companies that our clients work at that are actively allowing this. That's step number one. Does your company allow it, number one? And then how do you take the steps to execute it?
And Rory, just to add in there, again, this is a phone call. In order to turn that feature on, the after-tax automatically getting converted to a Roth, like Rory just mentioned, right? It's as easy as doing a 5 to 10 minute phone call, as many of you have done with me in the past. It's hands down the best way to do it to make sure everything is being treated the right way. And as I mentioned, these are becoming a lot more common. So, if there's any questions, please direct them our way. And if we want to try and execute on the strategy, it's an easy phone call that you and I can do together and just get that feature turned on, make sure there's no previous after-tax dollars in there, and go from there.
Absolutely. I mean, that's a great way to end it. That's a great takeaway that hopefully we've provided some education, we've provided some examples. There are some moving parts to this. If done or executed incorrectly, it could result in some additional taxes. But this could be a viable strategy to really supercharge your retirement. So use this as a resource, not only for yourself, but for any friends, colleagues, family members, to see if this is something that could be taken advantage of and could be utilized as part of your financial goals and your own retirement plan. So Shane, thanks for joining me here today and going through this. This is one of our favorite strategies. So hopefully you're as excited about it as we are. If you're taking advantage of it, maybe this just kind of solidified the why. But in any event, thanks for tuning in for the July webinar. We look forward to seeing you in August. Have a great rest of your summer and have a great week. Thank you.
Thanks, everyone.